Markets can remain irrational longer than you can remain solvent. And this is none more true than Nvidia's earnings. The chip giant crushed earnings, but the street did not seem impressed. So this begs the question, have the markets overpriced in rate cuts and earnings for 2024? With housing data showing clear signs of a slowdown, today we talk about the risks, how to manage it, and the big what if. What if the markets are wrong about next year's rate cuts? Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. If you like this video, please subscribe, hit the notification bell. Let's get into it. It was a very mixed day today and a lot of selling led by technology. We did see sort of a rotation, you could say, from tech into defensives as well as utilities. Tesla put up a very stellar day, 2.3%. It continues to just defy logic in spite of its earnings and margin decreases, as well as healthcare. Some of the smaller names in healthcare put up a fantastic day. All in all, a very mixed day across the street. And we had earnings, okay? We had the big one. Nvidia reported earnings today after the bell, and it was very, very good. They beat on revenue, they beat on EPS, they beat on data center revenue, and gaming revenue came in better than expected. Very, very good earnings, a double beat, but the street wanted a miracle. They were bid down nearly a full percent, I believe 1.9% now after hours. Don't quote me on that. And that is because the street was expecting more. Okay, they were expecting earnings as high as $21 billion and we only got close to 18 billion. I don't know what the street wants. They want a miracle. It is what it is. I do think that a lot of this price action has to do with options. There is so much open interest in this strike area right here, and most of it is expiring on Fridays. If we are expecting some form of a jump because earnings were good, and I do think we are going to rally on this, it's going to come Friday once a lot of this, call interest just expires. But we are getting deeper into greed territory. We were literally neutral 3 days ago, and we are now deep into greed territory. And it just shows where investor sentiment is right now. We've exited correction territory, and the market is looking very greedy, looking to push into extreme greed. And I think we do. This is why I think we go into extreme greed next week. This is the Nasdaq Turkey wrap. And pretty much when the prior week was positive, the current Wednesday to Friday normally returns 1.03%, 30 wins, 0 losses. And we normally see a 0.64% positive return on the Wednesday and a 0.39% positive return on the Friday. So if you just want to play the stats, this is very positive stats, very bullish stats, especially when we've had the day we did today in the Nasdaq. Now, this is also coming off the shortest correction in recent history. In fact, the second shortest correction since 1970 in the S&P 500, only 16 days. And this is because the market was very reflexive to yields and earnings. Now, let's have a look at earnings. The overall S&P 500 earnings growth for 2023 has been about 2.3%. Over the next year, in 2024, earnings are expected to come in at 11.2%. Double-digit growth, pretty good. Now, where does that put valuations? It puts forward 12-month price valuations at about 19.1. That's actually up from its 17 average in 2022 and about 16 on its long-term average. So the market, you could say, based on its longer-term averages, is overvalued, but these are the expectations we are expecting for 2024. We have to see if we can actually meet these expectations because US profit estimates have seen downgrades for the 9th straight week. This is something we really need to keep a look at because a lot of earnings, a lot of yields are already priced in. If the market doesn't meet its expectations, we are going to have to hedge. We did get the FOMC minutes this week and the Fed was fairly hawkish, no surprise. I think what the Fed wants is yields probably to just move higher or kind of stay where they are at the moment because they don't really want to hike, and higher yields seem to be doing the job for the Fed. But treasury yields continue to fall despite the hawkish Fed, and you think that yields rise when the Fed is hawkish. And yields continue to fall mostly because the US housing market is slowing faster than expected. And you could see across the curve, except for the stubborn 3-month, all of the yields fell from the 30-year all the way to the 1-month. We are expecting a 30% rate cut in March as well as a 43% rate cut in May. And generally speaking, it takes about 8 months from the last Fed hike to the first rate cut. But this is what normally happens after a rate cutting cycle. A lot of you would think that if Fed cuts rates, stocks go to the moon. That's not actually the case, because the market's price expectations in the future of about 9 to 12 months. And so this is trading days from the first Fed rate cut to the S&P 500 market low. 195 days into the rate cutting cycle, we have about a 23.5% decline. And this is based on figures from 1981, 89, 07, 08, 2001, 2002, and 2020. And if you actually look at all of these dates, these are recessionary periods. Just something to consider that, a lot of these dates have been in recessions. So in a rate cutting cycle, what we might actually do is look for other stores of value to keep our money, because if stocks are going to go down 23%, we might need a hedge, and gold might be one of those. So this is what happens to gold when the Fed stops hiking and then cuts. So you can see here that there's 3 separate instances where the Fed stopped hiking, cut rates, and in every instance gold rallied 66% in the year 2000, 189% from 06 to 2012, and 50% from 2019 all the way to 2021. And this is where we are right now. It does look like cuts are coming, so we could see a very strong rally in gold over the next 18 to 24 months. But what about oil? In hard currency, oil does look pretty cheap right now. The oil gold ratio is back to the level in the Bretton Woods era. When oil gets to this level here, when the ratio gets to this level right here, we normally see sustained rallies in the next 18 to 12 months. You see rallies right here, rallies right here, rallies, and maybe we could see a rally to the 180, 200 mark in the oil gold ratio. I'm going to keep you guys up to date on this one. And this is why BofA expects oil to be the best performing asset of 2024. They expect an 11 to 13% gain. If you actually have a look at gold, they do expect a 1 to 3% gain. And going back to the oil gold ratio, for this to increase, one of two things need to happen. Either gold needs to decrease, or the price of oil needs to increase, or both can happen and they can meet in the middle. And I think that's what BofA is expecting with these kind of returns for 2024. So keep a lookout on oil and gold. Commodities could perform really, really well next year. Now, I put this poll on my YouTube community page this past week, and if you're watching this on Twitter, go ahead and follow me on YouTube. I post all my videos there as well. And it was the next 100 points in the S&P 500. 36% of you voted up, 64% of you voted down, and we are about 45 points higher from when this poll was posted, and this was posted on Saturday evening. However, this was only 69 votes. It wasn't anything big to go on. The sample size was pretty small, but here's an actual sentiment survey with a huge sample size. The AAII sentiment survey, we are in 43.8% bullish sentiment, 28.1% bearish sentiment. So a lot of people are bullish. And while this does look pretty big, we want to see this number get bigger before we see a prolonged sell down. Generally speaking, we want to get in the 50% range. You could see here that the 1 year bullish high and the 1 year bearish high, when they reached 50%, it normally was the lows or the highs, depending on which one you were looking at. And what that means is we just want to get plenty more people bullish before we use them as liquidity. And same is true for those that are bearish. Now let's talk about stocks and the S&P 500, the SPX. The call resistance level at 4,600 has not moved. We are still there, and we are sitting in this huge call gamma strike at 4550. If we do break above the 4550 level, expect this to go to the 4575, and then 4600 is probably where we're going to get to the end of the week, middle of next week, I assume. I mean, bears really did try to get this lower today. There was a ton of weird data, especially in the housing sector, that came in, and we still couldn't get lower. So I do think we're probably going to sit in this range for the rest of the week. Let's go in the charts. This is the chart we've been following for a while. We said that this is where we're going to buy this key support zone. This is the 4600 big gamma call resistance strike, and this is where we are right now. We had a fairly bearish day. We opened at the highs of yesterday, as you can see. Then bears did sell us all the way down to here. We did get some bull recovery as yields fell. We sort of closed in the middle, just above 45.40. But let's talk about seasonality. So November is often the best month of the year, and Potentially we could be starting to see this dip after today's price action, but as it stands, we've just absolutely rallied month to date. But we are still expecting gains because the end of November tends to be very, very strong, particularly after the Thanksgiving period. And here's some more stats for you. So this is the Tuesday before Thanksgiving to the second day of the new year. And generally speaking, the SPX since 1950 has had an average win of about 3.78%, an average loss of 2.13%, nearly 80% of the time. 58 wins, 15 losses. And I also posted this stat on X. The S&P 500 has seen an 8.4% increase month to date, marking the third best start to the month historically. In 1980, the gain was 9.1% and 9.5% in 2020. In both instances, stocks gained 1% and 1.1% for the rest of the month. And that goes to show that this chart right here, even after strong early gains, we still see further gains, even when we've been upward of 8-9% for the month of November. Now let's move on to dark pools. There wasn't much in the way of volume for any of the big names, just buy trades at the end of the day, but there was something very interesting on the VVIX. We saw a very, very big trade come in here looking to buy long volatility. It looks like a speculator is obviously hoping on some form of an increase in implied volatility. I really doubt they're going to be short vol at this area, so I'm assuming that this is a buy looking for a play to get in on a long vol play, which would be bad for equities, but I would take it with a grain of salt. It's Thanksgiving week, so take it with a grain of salt, guys. Economic data. So tomorrow we have initial jobless claims, and then on Friday we have manufacturing PMIs and global services PMI. And according to FX Street, this is high impact data. So we'll keep an eye on these into Friday. If you're here up until now, thank you so much for watching, guys. If you like this video, please give me a like, subscribe, hit the notification bell, leave a comment. You know I love you guys.